Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories in your favorite company's filings. And today we are looking at Cincinnati Financial Corporation, a company that has been keeping things quiet on the financial front lately. But what happens when money talks and needs a bit of a refresh? Cincinnati Financial Corporation, or Cincinnati Financial Corp as they are fully known, just filed a special report, a Form 8K, which is like a heads up to everyone about important things happening right now. And what happened on the 10th of October 2025 was a pretty big deal for their money management. Basically, this filing is all about a new deal Cincinnati Financial Corp made. Think of it like upgrading your house when the old plumbing is getting a bit leaky. They had an old loan agreement called the Terminated Credit Facility, and they just replaced it with a brand new one, the 2025 Credit Facility. So, who are the players in this new financial game? On one side, we have Cincinnati Financial Corporation and its subsidiary CFC investment company wearing their borrower hats. On the other side, we have some big banks stepping up to lend money. Fifth Third Bank N is taking the lead as the main money manager, and the Huntington National Bank is also playing a key role as a joint arranger. It is a syndicate of lenders, meaning several banks are pooling their resources to offer this new credit line. Now, about that old loan agreement, the Terminated Credit Facility, this was originally a $300 million deal that started way back in 2014. It had been updated and tweaked 5 times over the years, showing how businesses adapt their financing. Even though it was set to mature in February of 2026, they decided to wrap it up early on the 10th of October 2025. So, why let it go? Probably because the new deal is just better for them now. And here is the exciting part. The new 2025 credit facility, this is just a small tweak. It is a significant upgrade. They've secured a new $400 million unsecured revolving credit facility. What does that mean in plain English? Unsecured means they didn't have to put up any specific assets as collateral for this loan, which is generally a sign of confidence from the lenders in the company, as overall financial health. Revolving credit facility means they can borrow money, pay it back, and then borrow it again, up to that $400 million limit. It's like a flexible line of credit. This facility also allows them to get letters of credit, which are like guarantees that banks issue to assure payment to parties in a transaction, also up to that $400 million total. This new financial lifeline is set to last for a good few years, expiring on the 10th of October 2030. But here is a little bonus: they have the option to extend it for another year, twice. So they could potentially keep this facility open until 2032, giving them long-term financial flexibility. That is a pretty solid time frame for planning. Now, let's talk about some of the cool features packed into this new facility. It has a $400 million accordion feature. This is a neat provision that allows the borrowers to increase the size of the credit facility by an additional amount if they want to, subject to certain conditions and lender approvals. It's like saying, if we need more, we can potentially get it. They also have that $400 million sublimit for letters of credit we mentioned, and a $75 million sublimit specifically for swingline loans, which are usually short-term loans to immediate immediate cash needs. These features offer a lot of adaptability. Now, every loan comes with rules, and these are called covenants. One of the most important ones here is that the borrowers are limited to a maximum debt to capital ratio of 35%. This means that over 35% of their total capital structure cannot be made up of debt. It is a pretty standard measure to ensure the company does take on too much debt relative to its equity, keeping its financial risk in check. A lower ratio generally means a healthier balance sheet. Of course, there are also conditions where the lenders can ask for all the money back immediately. These are called events of default. Things like failing to make payments on time, breaking promises made in the agreement, or not following the rules, which are the covenants. If something like that happens and it is not fixed or forgiven by the lenders, they can demand the entire loan amount instantly. It is the standard stuff to protect the lenders. It is interesting to note that while there isn't a strict minimum credit rating requirement to borrow under this facility, the actual cost of maintaining it and borrowing money from it will depend on CINCINATIFIN, ALCIALCO. Peace ratings on their long-term debt that isn't guaranteed by anyone else. This means their creditworthiness still plays a big role in how much their borrowing costs them. And like in many large financial dealings, there is a mention of existing relationships. Some of the banks involved in this new credit facility have previously offered and might continue to offer other services like helping with investments, issuing stock, providing loans, and general financial advice to Cincinnati Financial Corporation and its related companies. This creates a kind of banking ecosystem where everyone benefits from the various services offered. The full details of this massive $400 million deal are attached as Exhibit 10.1. It is the actual contract that spells out all the terms and conditions between Cincinnati Financial Corporation, their subsidiary, and all the lending banks. So, what is the big picture here? On the surface, Cincinnati Financial Corporation is upgrading its borrowing capabilities with a larger credit line that offers more flexibility and a longer sunset. This suggests they are confident in their future operations and potential need for capital, or perhaps they read just proactively managing their financial structure to be more efficient. Replacing an existing facility with a new, larger one shows a strategic move to secure better terms or greater capacity for growth. The inclusion of features like the accordion clause indicates a forward-looking approach, preparing for potential expansions or unforeseen needs. The 35% debt to capital ratio is a healthy limit, showing a commitment to financial prudence. However, we also see that their own credit rating still directly impacts the cost of this money, meaning they need to maintain investor confidence. Overall, this move seems aimed at strengthening their financial foundation for the years ahead. It is not a sign of distress, but rather good financial housekeeping and strategic planning. Alright, that is our breakdown of Cincinnati Financial Corporation's latest filing. What is your take on these new credit arrangements and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Done. Don't forget to check out the Discord community linked in the description for more exclusive content and discussions. Thanks for watching. See you next time.